All right, if you care about markets, you need to slow your scroll for a second, because something just happened that almost never happens. In the last 24 hours, silver dropped more than 21%. That's not a typo. From roughly $120 an ounce to about 97 in a single day, about $1.4 trillion gone. And here's the part most headlines are getting wrong. This wasn't driven by a sudden collapse in physical demand. The real trigger is hidden in the paper market, and both futures positioning data and exchange margin reports are already confirming it. Stay with me, because I'm going to show you why this kind of move usually shows up near inflection points, not at the end of the story, and how you can recognize this pattern next time before the crowd does. Before I explain what caused this, let me teach you something most people never really internalize about commodities. Price doesn't move because people change their minds overnight. Price moves because leverage breaks. Think of the silver market like a skyscraper built on borrowed money. It can stand tall for a long time, even sway in the wind, but once the bolts start snapping, gravity takes over. Most people don't understand that futures markets are not about owning silver. They're about controlling a lot of silver with very little cash. So when price moves too far, too fast, it's not fear that hits first, it's math. And math doesn't negotiate. You can feel confident in a position. You can believe in your thesis, but if the math says you don't have enough margin in your account, the broker doesn't care about your conviction. The position gets closed, and that's what you need to understand about what just happened. This wasn't a crisis of confidence. This was a crisis of arithmetic. If this is making sense, drop a comment below and let me know if you've ever been caught in a margin call yourself, because once you've felt that pressure, you never forget it. Now here's what's actually happening. Let me break down the sequence in plain language. Silver went parabolic. That's the first ingredient. As price accelerates upward, leverage builds quietly underneath it. Traders add futures exposure because the trend looks unstoppable. You've seen this before. When something's going up every single day, the fear of missing out becomes more powerful than the fear of losing money. So people pile in, they use maximum leverage, they think they're riding the wave, but they're actually building the wave that's about to crash over them. Then volatility spikes. That's the second ingredient. And this is where things get mechanical. Exchanges respond by raising margin requirements. Now, why do they do this? It's not personal, it's risk management. When an asset starts moving 10, 15, 20% in a day, the exchange needs more collateral from traders to cover potential losses. So suddenly positions that were fine yesterday are underfunded today. You could be sitting there watching your screen and boom, you get a margin call. Not because you lost money yet, just because the rules changed. So when silver slipped just a little, margin calls went out. And here's where it gets really important. When those margin calls couldn't be met, positions were forcibly liquidated, not sold by choice, liquidated by rule. And here's what's wild about this. Every forced sale pushes price lower, which triggers the next round of margin calls, which forces more selling. It's a cascade, a mechanical cascade. You don't need sentiment to turn bearish. You don't need bad news. You just need the first domino to fall, and the rest follows automatically. So when the initial trigger hits, the market stops being a market and turns into a liquidation engine. It's not about value anymore. It's about who can meet their margin requirements and who can't. The people with the weakest hands, the most leverage, the least capital, they get flushed out first, then the next tier, then the next, and price just keeps falling until there's nobody left who needs to sell. But here's the part that should make you stop and think. Physical silver didn't suddenly become 20% less useful in a day. The fundamentals didn't evaporate. Industrial demand didn't collapse overnight. Solar panel manufacturers didn't stop buying. Electric vehicle production didn't halt. This was paper leverage unwinding, not real demand disappearing. And that distinction matters, because if this was a fundamental breakdown, if something changed in the real economy, then, you'd want to reassess everything. But if this is just leverage getting squeezed out of the system, that's a different story entirely. This is the exact same playbook we've seen before. In 2008, precious metals were crushed during forced deleveraging, only to bottom while fear was still everywhere. I remember watching gold get sold off alongside everything else when Lehman collapsed. People were saying the gold trade was over, that it failed as a safe haven. What actually happened? Leveraged funds needed to raise cash for margin calls in other positions, so they sold whatever was liquid. Gold and silver were liquid. 6 months later, gold was making new highs, same pattern we're seeing today. In 2011, silver collapsed after a parabolic run when margins were raised repeatedly, shaking out leveraged longs. Silver hit nearly $50 an ounce in April. By September, it was back in the 30s. The narrative was that the silver bubble had popped. But what really happened? The CME raised margin requirements 5 times in 9 days. 5 times. That's not a market deciding silver is overvalued. That's an exchange forcibly reducing leverage in the system. And again, what happened next? Silver consolidated, built a base, and rallied again when the leverage was gone. In March 2020, gold and silver both sold off violently as funds liquidated anything they could to raise cash. Gold dropped almost 15% in a week. Silver dropped over 30% in a safe haven asset during a pandemic crisis. Does that make fundamental sense? No, but it makes perfect sense when you understand that hedge funds were facing redemptions and needed dollars immediately. They sold what they could sell, not what they wanted to sell. Every time this has happened, the emotional narrative said it's over, while the structural reality said this is a reset. Zoom out and you see the same rhythm over and over. Leverage builds, volatility spikes, forced selling hits. Then price discovery begins again without the borrowed excess. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this keep going lower? Of course it could. Markets don't owe anyone a bounce. We could see silver test $90. We could see 80. I'm not sitting here telling you the bottom is in. And yes, manipulation narratives always surface during moments like this. You'll see people saying the banks did this on purpose, that this was orchestrated to shake out the little guy. Maybe that's true, maybe it's not. But here's the thing, whether you believe in manipulation or not doesn't change what actually moves price in the short term. Focus on what you can control. Risk, position size, time horizon. The way I see it, arguing about villains doesn't help you navigate volatility. Understanding mechanics does. You can be right about manipulation and still lose money if you don't manage your risk properly. There are probably 3 types of people watching this right now. The first is the panic seller. You're staring at the screen thinking you should have sold yesterday. You're looking at your portfolio and it's down 20, 30, maybe 40% if you were leveraged. And you're thinking, I need to get out before it gets worse. If that's you, let me be honest. Most selling in events like this is already forced. The leverage players already got flushed. If you're holding physical or you're in a cash position, selling now is emotional, not strategic. You're selling to the people who understand what just happened. Think about that for a second. The second type is the aggressive dip buyer. You see a 20% drop and your instinct is to go all in. I get it, I've been there. The math looks incredible. Silver's on sale, but patience matters. Let the market show you stabilization first. Wait for the volatility to compress, wait for the selling pressure to exhaust itself. A few days of patience could save you from catching a falling knife. There's no award for buying the exact bottom, but there is a real cost to buying too early and watching it drop another 15%. The third type is the long-term holder. You believe in silver's fundamentals, but this move shook you. You didn't sell, but you're questioning everything. If that's you, zoom out. Your thesis didn't change in 24 hours. The reasons you bought silver, whether it's monetary debasement, industrial demand growth, supply constraints, those things are still intact. Your time horizon is your edge. The traders with leverage don't have the luxury of waiting. You do. And for everyone, the universal principle is the same. Separate volatility from value. They are not the same thing. Volatility is the price you pay for exposure to an asset. Value is what that asset is actually worth over time. So here's what I want you to answer in the comments. Which type are you? And more importantly, what's your plan? Because having a plan, even if it's just to do nothing and hold, that's better than making reactive decisions based on fear. Here's where I stand. I'm not euphoric and I'm not panicking. I'm watching. Let me tell you what I'm personally watching. First, I'm watching the $95 to $100 zone to see if price stabilizes instead of free falling. If silver can hold above 95 and start building support, that would tell me the forced selling is done. If it slices through without any resistance, that tells me there's more pain ahead. Second, I'm watching volatility compression because when forced selling ends, volatility usually collapses before price reverses. You'll see the big swings get smaller, the range tightens. That's your signal that the liquidation engine has run its course. Third, I'm monitoring physical premiums, especially in Asia, because in past cycles, elevated premiums during paper sell-offs preceded sharp upside repricing. When physical buyers step in aggressively while paper sellers are panicking, that divergence doesn't last forever. Based on my analysis, this move was mechanical, not emotional, structural, not fundamental. The fundamental picture for silver hasn't changed. You've still got supply deficits. You've still got industrial demand growing from solar and EVs. You've still got central banks debasing currencies. None of that evaporated in 24 hours. What changed is that the paper market got over-leveraged, volatility spiked, and the system flushed out the weak hands. If history rhymes and silver stabilizes here, the move that follows could be significant because all that leverage is now gone from the system. I'm not a financial advisor. This is not financial advice. Do your own research. But I will tell you this, the people who understand these mechanics, who can separate the noise from the signal, they're the ones who don't panic during liquidation events. They're the ones who recognize that forced selling creates opportunities, not disasters. If you made it this far, you're thinking critically. That mentality will serve you well. Share this with someone who needs to understand what really just happened. Subscribe if you want more market education that cuts through the headlines. And stay sharp out there. Think critically, verify the data, and make your decisions deliberately, not reactively.